Welcome to the Explainer. Today, we're diving into a massive paradigm shift that is completely transforming financial technology from the inside out. We're way past the era where banks could just compete on having the most branch locations or slightly better interest rates. Today, the battleground is entirely digital, and the weapons of choice are agility, product-led growth, and just this absolute ruthless customer centricity. So, we're going to break down exactly how digital native challengers are rewriting the rules and what traditional financial institutions have to do if they actually want to survive this revolution.
Let's kick things off with a number that is just staggering: 99.8%. According to the Reserve Bank of India, in the first half of 2025, digital payments accounted for an unbelievable 99.8% of all transaction volume in the country. Let that sink in for a second. Digital-first finance is no longer some niche alternative option just for early adopters. It is the absolute default. The entire global market is shifting right alongside it, with the worldwide fintech sector projected to blow past $420 billion by 2029.
So, to make sense of this massive shift, here is our roadmap for today's explainer. 1. The legacy bank trap. 2. Product-led growth. 3. Agile 2.0. 4. Product manager versus product owner. 5. The fintech PM reality. And finally, 6. New metrics that matter.
Let's jump right into Section 1, the legacy bank trap. Agility versus 40-year-old cores.
The contrast between the old guard and the new challengers is just wild. When you look at the costs, traditional banks are spending around £150 per customer to operate. Meanwhile, neobanks are coming in at just £20. And you might be wondering, why such a huge gap? Well, it's because traditional banks are stuck running on tech cores built over 40 years ago. These are basically digitized ledgers that were never ever designed for today's complex use cases. So, an incumbent bank might throw a party for releasing new tech to production once a month. But a neobank, with an API-first architecture, they are releasing updates tens of times a day, every single day. This legacy tech is expensive, it's rigid, and it's exactly why traditional banks are struggling so hard to compete with the customer experiences that agile startups are offering.
Moving on to Section 2, product-led growth in banking. The product as the engine.
These digital native fintechs aren't just building better tech. They're deploying a highly disruptive strategy called product-led growth, or PLG for short. Think of it like this. It's a framework where the product itself is literally the engine for the business. Instead of relying on heavy-handed traditional sales funnels, PLG leans entirely on the product's intuitive design to deliver immediate value. Just think about your own experience. Instead of a massive marketing campaign convincing you to open an account, the app is just so frictionless, and the onboarding is so seamless that you explore the features, realize the benefits, and become a loyal user entirely on your own. It's a self-validating growth model, and it works incredibly well.
But how does a massive traditional bank actually adopt this? They have to follow a very specific roadmap. First up is PLG assessment and visioning. They have to identify digital-first products, like maybe a personal finance tool, that can deliver value fast. Second, user-centric design, which means ruthlessly removing all friction from onboarding. Third is agile and cross-functional alignment. You have to break down those old-school silos between compliance, marketing, and engineering. And finally, launch, measure, iterate. You use behavioral analytics to constantly refine that user journey. It's not just a software update. It is a complete cultural and structural reset for these incumbent institutions.
And to execute that kind of growth, standard methods just won't cut it. That brings us to Section 3, Agile 2.0, Beyond Scrum, Scaling Enterprise Agility. You see, Agile is no longer just about a few software developers doing Scrum and Kanban. We're talking about scaling enterprise agility. We're moving from rigid frameworks to adaptive principles that encompass the whole organization, even HR and finance. A big part of this is lean portfolio management, which replaces slow annual budgeting with dynamic funding that connects executive strategy straight to delivery. But here's the real game changer: continuous product discovery. This is a massive shift toward outcome-based Agile because the ultimate goal here is to prevent teams from building the wrong product really fast. Instead of suffering from scope creep, teams focus intensely on delivering a minimum viable product, or MVP, using iterative delivery. It's all about prioritizing actual outcomes over just churning out outputs. Toss in AI-driven project management to predict risks, and DevOps at scale, and you've got a system actually built for modern financial complexity.
Now let's talk about the humans driving this. Section 4, Product Manager versus Product Owner, Strategist versus Tactician.
Understanding the split between these two roles is absolutely crucial, and getting it wrong is a massive trap. A product manager is your strategist. They own the what and the why. They're looking at market fit, setting the big picture vision, and working across the business. A product owner, on the other hand, is your tactician. They own the how and the when. They manage the sprint backlog and make sure the engineering team keeps up their delivery velocity. And how do they prioritize that sprint backlog? They use rigorous ROI-based prioritization. Basically, they map backlog items onto a chart, putting development effort on one axis and the financial cost and customer value on the other. It's a brilliant way to visually determine the highest return on investment. So mixing these roles up is fatal. If you need strategic direction but you hire a tactician who's just grooming a backlog, your fintech roadmap could literally stall by 6 months. Clarity here is non-negotiable.
But if you are that product manager in fintech, what does your life actually look like? That's Section 5, the Fintech PM reality, stewardship over roadmaps.
We have a quote here that is a serious reality check. Not user obsession, but failure containment is the real KPI. In the highly regulated world of financial services, a PM isn't just sitting around dreaming up flashy, viral features. Your actual job is acting as a hedge against systemic risk. You are the translator between the legal team demanding zero risk exposure and the engineering team asking for 6 months to build the thing. At the end of the day, your credibility doesn't come from your sprint velocity, it comes from having an absolutely flawless audit trail.
Let me give you a real-world example from our sources that really hits the nail on the head. A PM at a fast-scaling neobank shipped this beautiful one-click savings feature. It was a massive hit. It boosted opt-ins by 37%. Huge success, right? Actually, no. The entire feature was rolled back just 2 weeks later. Why? Because internal audit flagged it as a potential UDAP violation. That's an unfair, deceptive, or abusive act or practice. The PM simply hadn't consulted compliance before launch. In fintech, you don't really own the roadmap. You steward it through intense layers of regulatory control.
And that reality perfectly explains this number, 14. That is the average number of months it takes for an external product manager hire to ship their very first regulated feature at a major card issuer. 14 months! Compare that to just 8 months for an internal transfer. It's not because the external hire isn't talented, it's because of trust latency. In banking, you have to earn access to compliance reviews and audit logs, navigating the operational trauma of balance sheets and settlement cycles. That is the real barrier to entry.
So, finally, how do we measure success in this lightning-fast, highly regulated environment? Let's bring it home with Section 6, New Metrics That Matter, the FinTech KPIs.
The benchmarks here have shifted dramatically in just a few short years. Take reconciliation cycle time. Back in 2022, a 24 to 48-hour end-of-day batch cycle was totally fine. By 2026, best-in-class operations, fueled by real-time payments, demand reconciliation in under an hour. Next, look at customer acquisition cost, or CAC. In the past, companies mostly just looked at marketing spend. But today, true unit economics demand a fully loaded CAC. That means you have to bake in the $5 to $25 per customer it costs just to run your KYC and anti-money laundering compliance checks. If your metrics don't reflect these realities, your business model is essentially flying blind.
Which leaves us with this final question to chew on today. As the financial world transitions from 40-year-old mainframes to API-first agility, you really have to ask yourself, are you just building a feature factory, blindly churning out updates? Or are you building an outcome-driven, risk-mitigated product ecosystem? Because the winners in the coming years won't just be the ones who build the fastest. They'll be the ones who intelligently align their technology, their product roles, and their compliance controls to create genuine, lasting customer value. Thank you so much for joining this explainer, and we'll see you next time.